Hey everyone, so Q2 for Lemonade just happened. The letter's out, as you all know. Not a great quarter. I mean, there are some positive things you'll see from my model. I'm going to show you guys and point out later on in the video, but let's talk about this quarter. I'll kind of walk through the letter, or at least parts of it, and give a bit of discussion. So they beat their top line guidance by a fair bit. And also premium per customer was higher than I was expecting, or at $360 per customer. This number right here, along with better sales and marketing unit economics, are also improving. I'll show you in a bit. It kind of makes me think maybe their existing customer base is upgrading their products almost sooner than Lemonade would like, potentially maybe than they want, that they're growing 2 quarters in a row, said they're really going to put the brakes on growth, but then they grew faster than they're expecting. Also more customers, a little bit more customers than I was expecting. So just flipping to my model briefly, about 2.7%, 2.3% to a total of 686 million IFP, or 687 as they show in the letter here. And the loss ratio, this is obviously the worst part of the whole quarter, 94%. I was thinking this was going to be more in the 80s, potentially high 70s. So yeah, this really sucks. The loss ratio really sucks, and it's my mistake for not, in the last video I presented, my mistake for not looking at the industry results more carefully of other insurers. But it's not the end of the world, but it is really frustrating when the loss ratio you're expecting to come down, you're expecting they're selecting better customers or filtering through customers better. At least it seemed like on a quarterly basis, there wasn't any crazy hurricanes, they were not in the winter, there wasn't a Texas freeze, and they still have a high loss ratio like this. You go, okay, what is happening? And it makes you question the thesis on an insurtech, even on insurance investments in general. Maybe in a climate changing world, is this too impossible of a task for these companies to really accurately predict the sort of losses they could have, and if there's too many regulatory hurdles that prevent them from quickly adjusting and changing the rates they would really have necessary to cover the possible costs they could have and the possible risks they could have. I know the loss ratio is really sensitive. It's the kind of thing you could have a quarter like this, and then the next quarter could be really good, and maybe it's way better next quarter. So it's definitely really difficult for anyone to predict, even for Lemonade to predict. But still super disappointing. I don't think it's like totally breaks the thesis, because there's a lot of other little small details I'm going to point out that are on track, but it is really frustrating. And just scrolling down here a little bit to more discussion on the catastrophes, it's interesting that they give values sort of with cat included and without cat included, but it is still really frustrating. As part of being an insurer, your job is you're going to have catastrophes that come and go. So I don't mind that they publish those results, like sort of excluding cat, to show that, but to me they're not like super meaningful results, other than maybe if it's a really rosy quarter, you could be closer to that excluding cat value. And they talk about how these severe convective storms, in other words, winds, tornadoes, thunderstorms, had a major impact. And maybe even it just wasn't on the radar as much for someone like myself, because you're not hearing in the news, at least I'm not hearing in the news, about major catastrophic events that are around these, but they could still obviously cause severe damage, and could really obviously did spike the loss ratio, at least what they're telling us here. And this is really, it's really encouraging. You look at like their other products, but they're smaller sort of ticket and smaller IFP products, but they're very profitable products right now. Renters, they said it was below 50% for the first time. That's all, all their renter customers, inclusive of any catastrophic impacts. And pet was also in the 70s for the first time. If they were a super niche, super lean, super niche insurance company that only had renters and pet, well, they'd probably do pretty well and could probably be quite profitable already, just with but they have much bigger ambitions than that, and if they were only doing that, maybe they wouldn't have had the capital and capital raised to build all the sort of efficient systems they have that allow them to get these kind of values. But what they're telling us here, though, otherwise, is that homeowners and car must have really bad loss ratios, or at least this quarter they did. Homeowners, excluding cat, was in the 60s. I mean, again, that's sort of like, oh, that's great, but you have to, obviously, you have to include catastrophes in insurance. So what was it actually? We're not totally sure, but I'm sure it was quite bad. Though also, from an IFP perspective, homeowners and car are going to suck up much bigger portion of the whole IFP dollar value pie versus pet and renters. So that, any swing here, maybe these are at 105%, and then these are at 50 and 70, but it equals out to their 94% loss ratio that they posted. Again, here's the downward trend of these products. Pet and renters are that's really wonderful and great, but homeowners, excluding catastrophe, also really impressive, but somehow they need to avoid or plan for or price for catastrophes better. That's the bottom line. Jumping back up to the top of the letter where it says Dear Shareholders, they talk about the reinsurance and synthetic agents and rates. That California recently approved 30% increase in homeowners and 23% increase for pet. We're taking more rates, seeing an acceleration in our rate approvals. We expect this will register in our loss ratios as new rates earn in over the coming quarters. So hopefully in the next 2 quarters we have to. In the next 2 quarters, they're telling us this really explicitly right here. We have to expect that the loss ratio is going to come down, especially you'd think by Q4, Q1, winter time, as long as there's no major Texas freeze or that kind of thing, the loss ratios have to be coming down. They still beat their guidance. Interesting, within all of this, they still actually beat their guidance with a $53 million adjusted EBITDA loss. Then they talk about their reinsurance, how that's restructured. They talk about synthetic agents. They even give an example down below, but I don't know if we'll need to cover that in too much detail. It's basically exactly as we kind of laid out here on the channel. And they talk a little bit more about synthetic agents, how they're shifting. I basically just think about it in a nutshell. Synthetic agents like a line of credit. It's different than just a big block of debt where you're paying interest on the whole block. It's more like a line of credit where you're siphoning off a little bit and you're only paying interest on the little bit you have siphoned off, and you're paying, a 16% return gets paid back to the synthetic agent company, General Catalyst in this case. And I kind of wonder how much synthetic agents they're actually going to use this year. I was expecting more and then a better guidance shift this year, but you kind of wonder if, because their loss ratios are still poor, then they're really not going to want to be pushing for growth this year. So we might not see a ton of synthetic agent use next in Q3, Q4 of this year. Maybe by next year, we're starting to see it more significantly. Maybe there's a huge ramp next year if it's a really positive year for Lemonade. But given their guidance wasn't as rosy and positive for the full year as I would have thought, so it makes me wonder or guess that they're not going to be using as much synthetic agents for the rest of this year. And the part of the contract says they can use up to 80% of our growth spend. So they don't have to use that much if they don't want to. And then scrolling down a little bit more here, back to the sort of end of the letter part, it says looking to the second half of 2023. Basically says what I just said, is that they're not going to put pedal to the metal until the loss ratio for new cohorts is in line with our targets across the board. We're already within the range for some of our offerings, renters and pets and home and car in certain geographies. This is where our moderate growth will come from. So there's certain little areas they're going to try to target, but more accelerated growth will wait until more rates come online. So there must be waiting that more rates are still being approved and updated before they can really push for those areas. And guidance for Q3, it improves a little bit. And looking at the guidance I gave for Q3, 51 to 49 million adjusted EBITDA loss, and somewhere between 199 to 196 loss for the whole of 2023. I thought this was going to be significantly better. Again, my guess is they're just really on pause with the growth mode until their loss ratios are getting better. So that's in theory what we're waiting for. Now flipping to my model, there are some little nuggets in here and little unit economics we're going to look at that are quite positive and are all moving in a positive direction. Loss ratio is not one of them. That really sucks. I mean, even if we'd had like 85% loss ratio, I still would have been quite happy, but 94, again, super frustrating. But annual dollar retention was a little bit higher than I thought, and I think that's partly because the premium per customer was a little bit higher than I thought at $360 per customer. So 87% annual dollar retention rate, which I calculate from that is my churn from 12 months prior as dropping down to 20%. So that's really good. Fantastic actually. I wasn't even expecting that till a few years from now, getting kind of to that point where you drop maybe about 20% of your customers are churning over a 12-month time. If we look at the graph for that, here's where we're at, 20% churn, and all the way back to if we go back a few years to 2020, we're at 40%, 30, and we're in the 30s for a while, and then for the last several quarters, maybe the last year, 2 years, it's been a march down from 30% all the way to 20%. So super, super positive to see that. Also, we have your customer acquisition cost and the amount of IFP we're gaining for customer acquisition spend. Two other metrics that are really valuable to look at here. And if you missed my last video, I talked about how I split up sales and marketing into sales and marketing, which Lemonade posts, but also into sales and marketing fixed costs and sales and marketing variable costs, or what they're spending to acquire customers and directly measuring. We won't know till the 10Q comes out where they'll actually give us this value, and I'll know exactly what the breakdown is between these two to add up to 24.8. So I'm taking a bit of a guess here, but I put in 11 million. Last quarter was 11.9 for the fixed marketing, and that leaves 13.8 million on CAC spend. And if you think about the amount of premium they gained, inclusive of the churn that occurred, that means they're getting now about $4 in IFP gain for every dollar of sales and marketing that they spend. So really, really good, really, really positive. And I was predicting, I haven't updated past this red line anything, so don't just sort of ignore some of those numbers. But really, really positive. In my last video, I was talking about how this number is going to go from, a few years ago at their IPO, it was around 2, and they said that in their S1, and then it had improved to 3, and now it's saying, eventually it's going to go 4, 5, 6, like maybe go 7, 8, 9 kind of range eventually long term. And we're already moving to 4, which just basically means they're getting a lot more premium for the amount of sales and marketing expenditure, which is really fantastic. And also this quarter, they spent about $108 per customer, which is very, very good. It might also mean that they're getting more renters customers and they're trying to avoid some of their other products. Maybe more renters, more pet customers as well. Might be less expensive, might be less competitive product lines to win customers over in. There's a little bit of uncertainty here, because if this sales and marketing fixed is higher, if say it's 13 million, actually, then these values get even better. There's even less customer cost per customer required, and you get more premium for every dollar that was spent under this line, because basically we know the two of these add up to the sales and marketing. But if you say maybe this one was less, maybe it was only like 8 million, then we're only going to be at a 3.29, still good, but not as good, and more similar range of $131 per customer. So we won't know that till the 10Q comes out, but either way, I think those metrics are looking good. And also sales and marketing as a percentage of gross earned premium is also improving, down to 15%. And if we look at a graph of total expenses relative to gross earned premium over time, again, used to be way, way high, has slowly trended down. It continues that downward trend. We're still at about 57%. So still a long ways to go, but the trend is still moving in the right direction. And other operating expenses like other insurance, we're at 9%. same as what it was last quarter. Tech and development were at 15%, so very similar to what it was last quarter. General administrative were down to 19%, so that continues its march down, which is very good to see. And total expenses, again, we're at that 57% versus 63% of gross earned premium where we were last quarter. And looking forward to the earnings call tomorrow, I'm sure we'll get an answer to this one, where this question, as it has the most votes and number of shares represented, and I ask how their plan to reach profitability is going. Can they give a timeline update? This kind of would be a very telling question, as it extends the guidance out beyond just this year. Another question I asked was about car rollout. When can we expect it to be available in all states? When can we expect it to be more aggressively pushed out as a product? I feel like there's a good chance this one will also be answered, given the amount of shares and votes represented or given there. But while it's a frustrating quarter, I think the thesis is still overly intact. I'll leave you with this tweet that I tweeted out the other day. I said, it really is amazing. They're gradually improving on multiple metrics. Loss ratio, not so much this quarter, but that's the one thing. But otherwise, expense ratio, yes, improved. Churn, yes, improved. CAC effectiveness, yes, improved. All at once. People are sleeping on this, but I believe the end result will be something special. Again, nothing on this channel is investment advice, but I still like Lemonade's chances. I just really hope they can get the loss ratio together. And we should see improvement in that through the balance of this year and in the winter. That's my hope. If we not, then maybe we have real concerns about their overall thesis around this investment. Okay, thank you guys so much for watching, for listening. Remember, it's in the bag.